Joining us now is financial advisor Rick Bloom from Bloom Advisors as we continue to have some questions in our economy, including inflation, gas prices, prices of other goods as the pandemic starts to really seemingly wind down, but these economic problems amount. We'll talk to him about all that and more. Rick, thank you very much for joining us again.
Well, thanks so much for having me. It's always a privilege to be here.
I appreciate having you on the program with us. So we heard so much about all these different factors that are going into our current economic state here in the U.S. and certainly in the state of Michigan, whether it be gas prices, the prices of goods going up, inflation. So that just a general question would be, what is the state of our current economy at this time? Are we is it in good shape? Is it in bad shape? Somewhere in between that we are maybe teetering between good or bad?
Yeah, we're in that flux period right now. And it's important to realize that the economy is different than the stock market. And the reason is we measure the economy by GDP, and that takes into consideration all economic activity. 40 to 45% of all the economic activity in this country is small business. Well, the markets don't reflect small business. And so our economy is struggling right now, for a few different factors. One, which is surprising, is that some employers still can't hire employees. So especially a lot of small businesses are hurting, and we've seen it with restaurants closing early, changing hours of operation, is that they can't find people. And that really is hurting the economy. And then obviously inflation is the major problem right now. And that's, a supply and demand issue. There's limited supply and there's huge demand. And it was thought that maybe last summer we would see the end of inflation, but unfortunately it's still around this summer and it's going to be around with us for a while.
As inflation continues to amount and it continues to have its impact on our economy and on the markets for various goods and items and services, how does it then take a greater toll on the economy, the longer that it is in such full effect as it is right now?
Well, you take a small business, for example, that doesn't have a lot of cushion. So what happens is they now, especially like with the employment situation, they have to raise their salaries and their wages they're paying their people, which takes away from the profits of the owner. The other aspect is raising prices, which we've seen a lot of small businesses do. And that causes your and I expenses to go up. We've also seen inflation, like you call it shrink inflation. You go to the grocery store and you would buy a bag a year or two ago, it was much bigger than the same bag today, even though the cost has gone up. So we see inflation in a variety of different ways, but the bottom line, it's a supply and demand issue. And when we have high inflation, it really does affect small businesses, which is the lifeblood of our economy, more adversely than it does affect large businesses.
We're joined by Rick Bloom from Bloom Advisors. Joining us on the Megacast, he is the financial advisor and also a Money Matters columnist with Home Life newspapers, joining us on the program today. And so, Rick, as we hear more about inflation, often the next thing we're hearing about, or something we're hearing about alongside inflation when it is in full effect and it's in the news, is recession. Can you explain to our audience what that may not be fully aware of what recession means, what it is, how an economy gets into recession, and how do they get out of it?
Well, the recession is an economic slowdown. We measure GDP, which is gross domestic product, which is the value of all goods and services consumed in America. When that number goes down for 2 quarters in a row, that's when they say it's an inflation. So it's a technical thing. It does appear that our economy is probably going to head into a recession next year. But I would tell people not all recessions are the same. We forget that 2 years ago we went into a recession at the beginning of the pandemic, and then it was over before anyone knew it. Things have a way of turning around relatively quickly. So I would tell people, just because we may go into a recession that doesn't mean that you should panic or anything of that nature. Recessions are not normal, but they're not abnormal. And again, the last one we went through was 2 years ago and only lasted a month or two. So not all recessions are the same.
And so as you mentioned that, Rick, and I think what is maybe part of the issue where people have such concern when they hear recession is they go back to the last major recession we had, the Great Recession, right around the time and shortly after the time of the housing market crash in 2008 and around that time. And as they hear about that, they worry about their financial future. They worry about their ability to provide those basic needs for themselves and certainly for their families. So as they are approaching a potential for a recession, even if it's a short one like we had a couple of years ago at the beginning of the COVID-19 pandemic, what precautions financially can people and families make to shoulder the load of a recession and the potential issues it could cause in their finances, or at least hiccups in their finances?
I tell you, the most important thing during a recessionary period is to get a hold of your expenses. You can't control your income, but you can control your expenses. And the sooner you can become more efficient with your expenses, that's going to get you through this recession. You know, one thing I always tell people is go through all those streaming services that you subscribe to. Determine which ones do you really need. I know people that have 3, 4 streaming services they never use anymore. So start getting rid of that. But for the average person, the way to get through this recession is to get a hold of your expenses and become more efficient with how you spend your money. Decide what you really need. That's what gets people through recession. And one of the things when you mentioned, the Great Recession, one of the things that where our economy's in a different position was back then, people were and corporations too, were very highly leveraged. Well, balance sheets are improved these days. And, we're not seeing the same type of carnage back then because people losing their houses, the whole bit. Most people have refinanced. They have equity in their homes. So from a fiscal standpoint, we're in a better position to handle a recession. The average person is in the average business than we were before the Great Recession. If you remember, before the Great Recession, you saw ads, borrow 125% on the value of your house, do this, do that. And we're not seeing that. And with so many people having low interest rates on their mortgages, they're in a much better position to handle this recession.
We're joined by Rick Bloom from Bloom Advisors. He's also a Money Matters columnist with Hometown Life magazine, newspapers as well. You can learn more information by visiting his website at bloomadvisors.com. That's bloomadvisors.com for more information, or visit hometownlife.com to read his Money Matters columns as well. And earlier, Rick, you had mentioned that when we're analyzing the strength of an economy, there's a difference between the economy and the stock market, and the strength of one may not be equal to the strength of the other, or it could be in some cases. And look at the stock market; it's been down a lot this year. Nasdaq down nearly 25%, a quarter in 2022. S&P 500 is in a 6-week losing streak, and is down about 16% below its all-time high. How do you assess the current state of the stock market, since you've already touched on the general economic state?
The stock market is volatile, and what inflation is doing to the stock market is eroding corporate profits, and then it's creating this fear aspect. And you have a lot of people selling out, which creates a supply and demand issue. The supply goes up, demand goes down, so prices are going down. There's a little bit of a panic out there today, and so the market is a little weak. But I would remind people 2 years ago, March 2020, the markets were down in the dumps. We were losing 2,000 points a day, which was a significant number, and everything looked bleak. Well, by the end of the year, markets had regained all their losses. So markets can turn around relatively quickly. We go through these periods of volatility, and sometimes they're not rational. When you do things in the short term, it's almost like gambling. So yes, the market is, having its trouble. But I would tell you, Let's say that you're someone who just graduated college, starting your first job. I'm saying now's the time to invest your money for sure. We always tell people, like me, I go shopping when stores have sales. Well, Wall Street's having a sale. And so people should look at taking advantage of it. It's just not investing new money, but also one of the things people should do, Tyler, is to look at doing Roth conversions. Because you do a Roth conversion now, you're going to pay a lot less tax than if you did it at the end of last year. So I think what people need to do is look at taking advantage of these times as opposed to trying to predict when the market's going to turn around. We've had many recessions. We've had many downturns in the market. 100% of the time, the markets have always come back, and they'll come back from this. So people should look at trying to take advantage of the down market we're having right now. And, one of the things that hurts the market is rising energy prices. Here in Michigan, we're now over $5 a gallon for gas.
We're joined by Rick Bloom from Bloom Advisors with us on the Michigan Megacast. You talked about the market volatility, the ups and the downs. It certainly has that. And then you look at certain aspects of the market, and when they have those big boom periods, you think about, okay, when is this momentum going to turn in the opposite direction, if not just simply correcting itself? And when you think about that, I look at the cryptocurrency market and how much of a sense of momentum it got in the last several years. Now it's starting to seem like it's correcting itself and having a little bit of a downturn that's affecting investors, particularly younger investors who got into cryptocurrency investments. Can you talk about the state of that market and give any tips to those that may be already investing or invested in cryptocurrency or interested in investing in cryptocurrency about the differences between strategizing for that market versus the general traditional, so to speak, stock market?
First of all, I would tell you that cryptocurrency is pure speculation as opposed to investing in stocks. And so you have to look at it as a much greater risk. It's a brand new investment. Most people have no understanding how it works. I tell the great majority of investors they ought to avoid things like Bitcoins and cryptocurrency. They're very difficult to understand. I mean, at one point we had Bitcoins over 60,000, and now it's down to in the 20,000. So they're very volatile. I generally tell investors to avoid it, especially the small guy. And one thing that you've run into with a lot of younger people, they've made a mistake, is they bought crypto, but they bought it on margin and they financed it. And I'm not a big fan of financing investments. I think that's, more like gambling. If I had like a Bitcoin, I wouldn't be selling it now because I think it's it's pretty low right now, and it'll eventually come back. But you have to have a long-term horizon. And there's so many things that could change with cryptocurrency, such as what is the government going to do? Are they going to have government regulations that can really hurt it? And the other thing people have to realize when they use crypto is there are certain tax issues that have to be reported to the IRS. And so you have to make sure that you comply with those IRS rules because it's not considered a currency for IRS purposes, which means every time you trade a Bitcoin, you're going to have to, report it. But I would tell most people they ought to avoid it. I have a firm belief, Tyler, that you should only invest in things that you understand. And I would tell you the great majority of people, even who deal with Bitcoins, don't understand it. So the average guy ought to avoid it because I don't think they have a chance of really making money on it. And that's what you want to do as an investor.
We're joined by Rick Bloom. He is a financial advisor with Bloom Advisors, and you can also view his Money Matters articles on Hometown Life newspapers as well. View those at hometownlifenewspapers.com. That's hometownlife.com for those articles, or bloomadvisors.com for more information on Rick and his team over at Bloom Advisors. Lastly, Rick, as money gets tighter, as people are cutting expenses, they're trying to maintain their lifestyle. Oftentimes, that means they're either going to be considering borrowing money, or they're going to move some of those expenses from paying in cash or paying with their with debit to paying with credit, and slowly but surely paying those things off. In that case, our credit card companies, when we have uncertain economic times like this, Are they big winners in this? Is this something that's good for these companies, at least financially, in the short term?
It is good for them for short term because people are going to carry more balances in their charge cards. It is not good for consumers. I always believe that you should never use your charge card to finance a purchase. It should be used for convenience purposes only. So I would tell people, you run that charge card should be the last thing. I'd even rather take out home equity loans that are going to be much more affordable. You're talking about the average charge card at 18.5%. And it's just hard to get out of that. So I think people should not be using their charge cards as a means of financing. They ought to be looking at all sorts of other options. Charge cards, and if you're going to use a charge card, make sure you shop it around and look for one that charges less interest, because it's worth the extra hassle to shop it around. So at least if you're using a charge card for financing, you're paying somewhat reasonable interest rates.
Yeah, it's a great tool also for building your credit score. If you use it correctly, and then that can also help you lowering your interest rates not only on that charge card but on other expenses as well.
And it's important for people to realize not all charge cards are the same. If you're someone that pays your bills all the time, on time, the interest isn't important. The perks are. On the other hand, if you're someone that always carries a balance, the interest rate is probably the most important thing. So it's important to know how you use your charge card, so when you shop it around, you can find the right charge card for your own individual situation.
Rick, thank you so much for joining us. Appreciate your insight on some of these complicated topics and giving people some advice so they can take those steps to ensure that their financial future is intact despite all the uncertainty in our current economy.
Well, thanks so much for having me. It's always an honor to be here, Tyler. Thank you.